so our next panel will be focusing on corporate tax policy, and I'm really thrilled to be introducing our moderator, Professor Rebecca Lester. Becky is one of our faculty fellows here at SIEPR, and she is an associate professor of accounting at Stanford's Graduate School of Business. Her research studies how tax policies affect corporate investment and employment decisions. In particular, her work demonstrates the critical role of reporting incentives, disclosure regimes, and information frictions in facilitating or altering the effectiveness of cross-border federal and local tax incentives. So she is very clearly the perfect moderator for this panel. Professor Lester has presented her work at the U.S. Department of the Treasury, the Federal Reserve, the OECD Global Forum on Transparency and Exchange of Information for Tax Purposes. Her work has been cited by the U.S. Joint Committee on Taxation and featured in numerous press outlets. And she's clearly, she's clearly a terrific moderator for this today. So I can't figure out where Becky is right now, but she's somewhere, I hope, in the room, or else I'm going to have to. There she is. Okay, Becky's over here. She's going to introduce our panelists, and it's just a gigantic honor to welcome her as the moderator of our second panel.
Super. Thank you very much, Mark, for the introduction. It's my pleasure to be here, and as probably one of the few accountants, it's really my treat to be able to participate in this discussion with so many prominent economists in this room. So let me first introduce our panel. I'm also going to take my ability as moderator here to help us transition between the individual session we just had into thinking about the corporate session. And I have the earlier panelists to thank because they already hit on some corporate topics. So I'm going to take just a few minutes after I introduce our panelists here to talk a little bit just about the corporate setting. I'm assuming that many of you already know something about corporate taxation, but I want to give, for those of you who are less familiar with some of the corporate issues, just some basic understanding of some of the hot topics in the space to hopefully put into context the remarks of the panelists today. But first, let me go ahead and ask our panelists to join me up here. So the first panelist is Juan Suarez Serrato. He's a professor of economics at Duke University and a research associate at the National Bureau of Economic Research. We are so thrilled because he's currently a visiting professor here at the Stanford GSB and very hopeful to try to keep Juan Carlos here for much longer than just this year. His recent research projects have analyzed the effects of corporate tax policy on firm investment, evasion, and productivity growth. He also studies how capital investment impacts employment and workers' wages, and how multinational corporations respond to international tax rules and regulations. Prior to joining Duke, he was a postdoctoral fellow here at SIEPR, and he received a PhD in economics from Berkeley. Our second panelist is Alan Auerbach. Welcome, Alan. Alan is the Robert Burch Professor of Economics and Law. He's a director of the Burch Center for Tax Policy and Public Finance, and a former chair of the Economics Department at the University of California, Berkeley. He is also a research associate at the National Bureau of Economic Research, and he previously taught at both Harvard and the University of Pennsylvania, where he served as the Economics Department chair. Professor Auerbach was Deputy Chief of Staff of the U.S. Joint Committee on Taxation in 1992 and has been an advisor to several government agencies and institutions. He is a distinguished fellow of the American Economic Association, having previously served as an executive committee member and vice president of that association, and as editor of the Journal of Economic Perspectives and the American Economic Journal Economic Policy. Professor Auerbach is a past president of the Western Economic Association International and the National Tax Association, from which he received the Daniel Holland Medal, which is the preeminent medal and honor from the NTA. He is a fellow of the American Academy of Arts and Sciences, the Econometric Society, and the National Academy of Social Insurance. And to connect one topic that I believe Scott touched on before, the destination-based cash flow tax that came up before, Alan and Mike Devereaux from Oxford are really the two economists who developed that idea. So I'm sure they'll be happy, or he will be happy to talk about that, putting him on the spot here, should more questions about that acronym come up. The last person I'd like to bring up is Marcus Heyland. So Marcus is a managing director in the Washington National Tax Office of KPMG. He recently rejoined KPMG after serving as an advisor from 2019 to 2021 at the OECD Center for Tax Policy and Administration, International Cooperation, and Tax Administration Division on the tax challenges of the digital economy project, often referred to as BEPS 2.0. We'll talk about that acronym here shortly. In that role, he provided strategic input into the technical development of Pillar 1, dealing with nexus and profit allocation, and Pillar 2, a global minimum tax. So you heard a little bit about these words before. I'll talk briefly about what those are, and then obviously Marcus and both Alan are going to expand on that. He was very closely involved in drafting the blueprints that were released to the public in October 2020, which was a huge, for those of us in international tax circles, that was a huge drop of information and different policy changes. Prior to joining the OECD, Marcus was a senior manager in the KPMG Washington National Tax Practice. He advised several large multinational enterprises as it relates to transfer pricing and international tax aspects of the 2015 OECD BEPS project, particularly Action 5, which relates to harmful tax practices, Actions 8 to 10, so aligning transfer pricing outcomes with value creation, and Action 13, which is on documentation and this new country-by-country reporting. Marcus earned a master's degree from Georgetown and has a bachelor's degree from the University of Iowa. So please join me in welcoming our esteemed panelist here today. Okay, so as I mentioned, I want to take just a couple of minutes. And so for those of you who may be less familiar with the corporate tax or some of the issues, just provide a bit of an introduction to help bridge from the earlier session we had on individual tax into what we're going to be speaking about for about the next hour and a half. Okay, so with that, we'll start here. The top green button. Okay, so I'm going to just very briefly talk about an overview of business taxation more generally. So how are businesses taxed in the U.S.? And then think about how, what are the corporate issues we'll focus on today. Talk briefly about some domestic tax issues that are kind of hot topics in the space now, and then international tax issues. Okay, so what we spoke about, or what the first panel spoke about, was really on the individual space. Broadly, when we think about transitioning into the business landscape, there are 3 different types of entities that can earn business income. And it's important to know that these differences exist because it also relates to how that business income is taxed. So if you look on the very far right, you see this box which says C corporations. That's really what we're going to focus on here today. The idea here is that a corporate entity would earn income. That entity itself would pay income tax. And then when that income is distributed to its shareholders, there's a second tax assessed related to dividend income that those shareholders report. Now, as Kim talked about in her discussion, the traditional 2 levels of tax holds when all of that income is distributed and also all that income is taxed at the shareholder level. I think she had this really nice graph showing that indeed more and more shareholders might be foreign or tax exempt, which then would remove that second layer of tax in a corporate setting. The other 2 I won't spend a lot of time on, but I think it's important to understand this pass-through taxation that was also discussed in the first panel. So there are 2 types of what we call pass-through entities, partnerships and S corporations. And they're called pass-throughs because the income is actually not taxed at those entities. It instead flows through to the owners and is taxed at the owner level. And so I put a box around those because I think it's really important to understand, also I believe Scott mentioned this too, that there is income that shows up. All 3 of these entities will earn business income, but the taxation of that income under the U.S. tax system is quite different depending on the choices of the entity and of the owners themselves. So again, we're going to focus on the corporate revenue or C corporate space. I think it's important to also put into context that, as they mentioned earlier, in general, the number of corporate entities has been declining over time. And the amount of revenue as a consequence generated from corporate entities has also declined. So you see this wedge that was like in the 1950s has generally gone down. And instead what has replaced it is a rise in payroll taxes, so taxes that are paid by employees working and also by companies too as their share of payroll taxes, and then this rise of individual tax. Remember what I showed you on the last slide, though, is that the individual tax includes a large chunk of that is going to include business income that is earned by partnerships or S-corp entities. So what I don't want you to take away from this graph is that just business tax has gone down. There's been a shift, so we still have a corporate income tax, but some of that business income tax is getting picked up or taxed through the individual tax system as a function of this increasing trend in partnerships and S corporations. Now, I will argue it's still very important to understand corporate tax because it is still a portion of the revenue that's generated. Also, if you think about any publicly traded company, almost 99% of them are corporations. So we have a set of very large companies that generate a substantial amount of income, maybe not always taxable income, but generate a substantial amount of income, are responsible for a lot of investment employment decisions. And so I would argue that it's still very important to think about the corporate tax, and we'll delve into some of those issues today. Okay, let me talk about two things in the space of the domestic tax system that I think it's important to know before we go into the panelists' remarks. So the first is that, I'm sorry, I don't know why these numbers have shifted from my slides here at home, but there were three major changes that have happened in the last, call it the last 5 years to this tax system. So if my numbers were aligned as on my home computer, you would see that those would be in 2017, 2020, and then again in 2022. So before that, there had not been a huge major corporate tax change since the 1986 Tax Reform Act. There was a pretty big shift in 2004 that allowed some international income to be repatriated fairly low tax, but all three of these are the more recent pieces of legislation that are affecting the corporate tax system. The biggest of which is what I believe Tyler had worked on during his time in DC, which is the Tax Cuts and Jobs Act. So I'm not going to go through all of the provisions. I just want to highlight the ones I think are most important for you to know to then understand the second part of this discussion. So the two biggest changes in my view of the Tax Cuts and Jobs Act from the corporate side is one, a huge reduction in the corporate tax rate from 35% to 21%, and that was really the first time in, call it 20 plus years that the corporate tax rate had changed, and a huge overhauling of the international tax system. There were also some increased expensing of capital equipment, changes to interest deductibility rules, et cetera. In 2020, in the CARES Act, there were some pretty important tax changes that happened there too, and most of those were designed really to provide relief, so to provide some type of relief to businesses and also incentives to keep individuals employed. So some of those changes includes kind of changing to the tax loss rules, also interest expense limitations. I mentioned those because those two rules were part, if I understand correctly, were part of what some of the revenue raisers were in the 2017 bill, and so those were relaxed a bit in the 2020 bill as a way to provide relief to corporations. And then most recently, the Inflation Reduction Act, it imposed a corporate AMT, which we're going to think about as a minimum tax, and I'll talk about that more in a minute, some excise tax on share repurchases, and then also some different types of credits for activities like energy or advanced manufacturing. Okay, so what do I think are the hot issues in the domestic space? So one is just trying to understand the effect of all of these tax changes. So what are the effects on these tax changes from business investment and employment? I think there's some new research that's coming out, but we don't really have a conclusive set of evidence in the academic literature, at least so far, on all of the investment, employment, and I'll also argue income shifting effects, because we're still waiting on more time, some more data, and especially with COVID coming right after that, it's been a little bit challenging. That's my view. I certainly would hope to dive into that topic a bit more with our panelists. There's also this new, what's called this book minimum tax, or this corporate AMT. And this is going to really follows quite nicely from the first session in terms of thinking about what do we do in terms of, are there excess rents in the corporate space? And if so, then how do we capture them? I think this is one mechanism that the most recent legislation is trying to tackle that question. And so under the premise that companies might not be paying their fair share of tax, the idea would be to now impose a tax not on taxable income, but on actually financial statement income, so income that gets reported to the capital markets, for example. Now, as an accountant in the room, what I teach my students is that those two sets of income numbers are actually generated through very different channels and serve very different purposes. And so we don't really know what would happen in this context if it gets imposed. Certainly, it might increase more taxable income and tax revenue for around, I think the estimate that one of my colleagues would say is around 70 to 80 companies would be paying potentially more tax if it's affected on financial statement income. But we also have some research with my accounting colleagues suggesting that actually, companies will just change their financial income, make it look more like tax, and so then it raises into question how much income we might get. So I think these are some interesting issues that will be fun to watch and see how those play out. On the international side, just to level set here what your knowledge may or may not be of international tax rules, most countries now impose what I'm going to call a territorial system. And so if you think about, take a UK company, income is taxed in the UK. If it's earned in the UK, it would be taxed in the UK. If that UK company had a German subsidiary, then Germany would tax that income. It may not necessarily be taxed again in the UK. And if the income was earned, say, in the Caymans, then the territorial system would generally say that it's also taxed only in the Caymans, but it's subject to some abuse rules that would vary across different countries. Now, one of the major problems going into 2017 is the US did not have this system. We actually had a much different system where the US had the ability to tax income. If it was earned in Germany, it would be taxed there and then taxed again to the extent that the rate was lower in those countries. So one of the big changes that happened in 2017 was a real overhaul in the US international tax system. And now the US has largely switched to that system with a number of different types of incentives, but also guardrails put in place to mitigate certain types of income shifting or other activities that would reduce the US base. And that's trying to get to this idea that companies might arbitrage across different types of tax rate jurisdictions. So this has been a huge area of interest and attention in the international tax policy arena. Obviously, when you have this system where companies pay tax under a territorial system where rates are lower, there was a race to the bottom of international tax rates. You could think about an old system of tax havens where those countries like Cayman, Cyprus, Luxembourg, would actually try to establish low rates precisely for the purpose of getting some income. Any income was better than zero, which is perhaps what they were getting before. And then I'll argue that there's been this rise of newer havens, so to speak, places like Ireland or Singapore that not only compete on trying to have a really excellent workforce and a good infrastructure, a high rule of law, but they also add or offer very low tax rates and tax incentives to get companies to move and then stay there. That's resulted in a lot of substantial cross-border income shifting because companies, again, are trying to arbitrage across these rates, and it's resulted in some very substantial policy responses. So these include things like the OECD Pillar 1 and Pillar 2 that Marcus spent years of his life working on and now advises on, where Pillar 1 is this idea of trying to protect the domestic tax base, which I believe is estimated to affect around 100 of the largest multinationals around the world, and then OECD Pillar 2 is intended to counter tax competition by imposing a global minimum tax. And then I want to highlight that in the 2017 law, there was this kind of alphabet soup of other incentives included, things that have names like GILTY, that are supposed to induce your thoughts of trying to crack down on what multinationals might be doing, and then also some kind of incentive provisions, things like the FDII that are trying to keep companies to retain international or intangible property here in the U.S. So that is maybe a year's worth of international or tax condensed into about 5 or 10 minutes. I intentionally did not go into details, but I was hopeful to give you just a bit of knowledge so that we can now dive into the remarks by our esteemed group of panelists. So with that, I'll turn it over to Juan Carlos, and then Alan, and then Marcus. Thank you. 10 minutes.
Well, thanks so much for inviting me to be in this panel. It's always great to be back at SIEPR. When we planned this panel, we decided I would try to bring in the economic policy research part of the SIEPR into the talk. So I'm going to be discussing some results from recent research, thinking about what the data actually say about what happens when you change different corporate tax policies. And a lot of the discussion we're having now is always very forward-looking. With research, it's always very backward-looking, right? So we have to think about what are the actual events that we actually observe, and a lot of these changes take a while to flow through the economy. But hopefully, I'm going to give you some case studies that can help us think a little bit about how future tax changes could impact the economy. So what do we do when we think about corporate tax systems? I kind of categorize research into 3 broad areas. One is we want to think about whether or not different tax policies matter for investment, employment, or productivity. And then we say, tax policy, a lot of times we focus a lot on just the income tax rate. But it turns out that there's a lot of different policies that matter, and perhaps I'm going to try to argue matter more than the income tax rate. So there are going to be things like depreciation deductions, rules aiming to limit profit shifting, or even other distortions that we wouldn't ordinarily associate with corporations, like sales taxes, right? These might also impact investment and employment. And then we also want to think about which of these policies are going to be more effective for a given objective, like, for instance, if you want to stimulate investment. So I'm going to show you one equation. It's only going to be one, but it's a way to try to think about organizing all these different incentives into one equation. So we can think about the rental cost of capital, which is how much it costs to actually hire a machine to actually use it to produce things. And it's going to have some factors that are going to be just economic factors. There's going to be an interest rate, a depreciation rate. If the Fed raises interest rates, it's going to be harder to invest. And then there's going to be a slew of tax factors, which is going to be what's going to be in this square bracket. So we're going to have an income tax rate. It could be federal, it could be state. When companies buy machines, they get to deduct the cost of those machines over time. They get to deduct the whole value, but because it takes a while to deduct them, the value today might not be equal to the value of the machine, right? So there's been a lot of talk already about expensing. The way we think about that is we have this variable z, where usually because it takes a while to deduct the cost of depreciation, that value of z is less than 1. If we have expensing, the value is 1. And so that's going to be one of the policies that I'm going to be discussing. We could have alternative policies like an investment tax credit, right? That instead of doing it through depreciation, today gives you a fraction back. And then I added a couple of other things, like for instance, what if you paid sales taxes on machinery that you had to buy, right? Usually we wouldn't think this is a good idea, but as I'm going to argue, it actually shows up in the data in some situations. And then finally, we might have distortions from profit shifting. If the machines that you buy today are producing profits that you're able to book in tax havens, that's going to reduce the tax cost of actually investing in those machines. And so those distortions are also going to appear. And so once you think about all those different parameters, it's actually a lot more complicated than just thinking about, okay, just what is the income tax rate? Right? So what do we do when we think about economic policy research? A lot of the empirical work that we do is using this natural experiment framework, where we say, okay, we have all these different policy variables. We're going to try to find some kind of change in these policy variables. We're going to try to find some groups of firms that were affected by these, or were more affected or affected, and we're going to compare those firms or regions to other sets of firms that were not affected by these rules. And then we're going to use data from different sources. There's been a big growth in research using tax data, which has become recently available, and that's been a big growth of the research in recent years. There's also other kind of private data that's becoming available, as well as more traditional confidential census data sets. We can also think about effects across regions, the way that we were just discussing the effects of the China shock. We can think about in a similar way the effects of different tax policies across different regions that are more or less affected. So I'm going to give you some case studies. I don't know how many I'll have time, but we'll start with one. So the first is going to be about depreciation rules, right? So the policy that I have in mind here is bonus depreciation. Since 2001, the US has incentivized investment by giving more generous depreciation policies. Now, these were also part of the TCJA, and the extension of these policies cost about $285 billion. So this isn't real money that we're talking about. Now, the way that we look at it in research is we're going to look at confidential plant-level data from the census, and we're going to identify the kinds of industries that benefit more from this policy relative to the ones that benefit less. The ones that benefit more are the ones that use the kind of capital that takes longer to depreciate for tax purposes, right? And then what we're going to do is we're going to compare how these different plants are growing over time, right? So this is a graphical version of the results. I don't know if, does this work? Oh, no, all right. There we go. So each one of these dots is going to give you the difference between the kinds of plans that benefit more from the policy to the ones that benefit less. And the idea is this policy came in 2001. Before 2001, these kinds of plans were trending similarly. So that kind of tells us they're probably comparable to each other. They're going to be a good experiment, right? Afterwards, you see that the ones that benefit more increase the use of capital, right? So this is telling you if you provide depreciation deduction incentives that lower the cost of investment, firms actually invest more, right? That's kind of like what we would expect to see. Turns out that expecting something and actually finding in the data takes a lot of work. So this is actually good evidence that actually happens. Now, there are these concerns. What happens if you actually invest a lot in capital? What's going to happen to workers? Are we going to replace workers with machines, or are we going to hire more workers? Well, this graph over here shows you the effect on employment. What this shows is that this depreciation deduction actually increased employment over a 10-year period, right? So that's kind of interesting. Depreciation deductions are increasing employment and investment. What are they doing to the plant? Is the plant just growing, or is the plant becoming more productive, right? So we can also look at plant sales, and we find that if you're using both more capital and more employment, you're going to produce more. So the scale of the plant expands. However, when we look at the efficiency, at the productivity of the plant, and we compare the outputs relative to the inputs, we don't see any big increases in productivity, right? And so this is, again, it's great that we know that firms will expand, they will grow, they will actually hire more workers. But at the same time, it's not some kind of panacea where they're just able to produce a lot more with the same amount of inputs. Right? Okay. Okay, so let me give you 5 minutes or? Okay, so I'll tell you about a second case study that I've looked at. This one's called the U.S. Possessions Tax Credit. So U.S. corporations for a long time have done business through Puerto Rico, and we've incentivized that by providing tax credits for the profits located in Puerto Rico. Prior to 1996, basically, if you have any profits located in Puerto Rico, you basically didn't pay any taxes there. So what happened is a lot of U.S. multinationals located their intellectual property there, and they actually did some real production as well. But then that meant that a lot of the profits generated in the US were taxed at a very low rate, just at the Puerto Rico rate, and avoided the US rate. Now, people were concerned that there was a lot of profit shifting happening, and so this was phased out between 1996 and 2006. Right? So what we're going to be doing here is we're going to use firm-level information. We're going to identify the kinds of firms that have affiliates in Puerto Rico that could benefit from this provision. And then we're going to say, okay, what happens when you get rid of this provision? What's going to happen to U.S. employment and U.S. investment? Is it the case that when you close down this form of tax haven that we had through Puerto Rico, does business come back to the U.S. or does it go away? Right? So the answer here is that it actually, the firms that were benefiting from this provision, when they're no longer able to basically shift profits to Puerto Rico so that they have lower taxes, they actually start investing less. So this is showing again that same idea where you have this difference between the ones that are benefiting from the incentive and the ones that are not. Afterwards, they do less investment. Right? Now, this is at the firm level. We can think, okay, these firms are going to face higher taxes, so they're going to do less investment. What happens to domestic employment? So here what we've been able to do is trace back this firm level shock to US communities. And here what we've done is we've said, okay, for each local labor market, or here each county, we're going to figure out which fraction of their firms are connected to these firms that could benefit from Puerto Rico. So for instance, I lived in Durham, North Carolina for a long time. There's a lot of pharmaceutical companies there, and a lot of those pharmaceutical companies booked their IP in Puerto Rico. Right? So when they're no longer able to shift those profits through Puerto Rico, what happens to employment in Durham, North Carolina? So here I'm showing you this map. This is basically that variation. We're going to, in red, are the kinds of counties that are more exposed to this kind of a policy shock. And then on the right, you can see that before this policy in 1995, the kinds of firms or counties that were more exposed to business in Puerto Rico were kind of growing at the same rate in terms of employment. But afterwards, their employment growth decreases substantially. So this is actually showing us that policies that limit profit shifting are actually decreasing economic activity in the US. Right? And so I think this is a piece of evidence that's kind of helpful to think about potential effects of something like GILTI. And again, this is something that happened in the past, but that's just the nature of economic research. We have to build on these kind of case studies to try to think about what happens to other potential policies. All right, so the last case study that I'm going to show you comes from China. And I love showing this graph because it kind of puts into perspective when we talk about investment, where investment is happening. So this red line is showing you the growth of industrial investment in China. And you can just see basically taken off relative to the US in blue and the European Union in green. Right? So when we think about corporate investment, it's important to consider the case of China. What we look at in this case study is a VAT reform that happened in 2009. So usually a value-added tax is supposed to let you deduct the cost of doing business, the cost of your inputs. But the way that the China tax system was organized before 2009, it actually placed a tax on the purchase of equipment. Right? So that's something that's not a great idea to have. And they realized this, so they're going to remove this tax. So in 2009, they removed this distortion, and this actually dropped the cost of investing by 15%. It's kind of like removing a 15% sales tax. That's a big change. So if we think about what's the general decrease in the cost of capital because of the Tax Cuts and Jobs Act, it's maybe 5%. So this is a really large change. And you might say, okay, well, this is a really weird thing that's happening in China. We shouldn't really worry about this kind of policy. It turns out that there's a US analog, which is that a lot of US businesses actually pay sales taxes on their inputs. Right? So a report found that in 2005, they paid about $100 billion in sales taxes to states. So again, this is a form of distortion that may be more important than an income tax. So what we're going to be doing here is we're going to use tax survey data from the Chinese Administration of Tax. And again, we're going to compare the kinds of firms that before were not subject to this tax distortion, and then to the ones that before had the distortion, but then it was removed. Right? So again, here I'm going to show you in blue this is the investment rate, so investment over capital of the kinds of plants that were not benefiting from or did not face the distortion. Investment rate is decreasing over this time period, and then it decreases again. But what's interesting is that this red line, which is the one that really faced the policy change, saw a significant increase in their investment during that time period. right? So again, if you remove the distortion on investment, that actually promotes investment. Okay, another thing that I've kind of like thought a lot in this context is just the fact that you might want to think about which of these tax instruments are going to be more effective, right? And one way to kind of think about that is to consider this figure. So this figure is showing you the distribution of investment across firms. What does that mean? It means that some firms are doing zero investment. Here in the case of China, about 45% of firms on any given year do not really invest anything in equipment. And then a lot of firms are doing a lot of investment in the sense that they're replacing a significant fraction of their existing capital in that given year, right? And so the way to think about this is the way that a lot of manufacturing companies invest is they replace existing plants. Once they build a new plant, then they don't invest for a while, right? So how does this bring us back to the idea of incentives? Well, if you lower the corporate tax rate, you're going to basically give an incentive to everybody, even if they're not investing. So there are going to be a lot of people that are going to benefit from a lower rate, but they're not changing their behavior. So that's not going to be a very effective form of stimulus. If instead you actually have a kind of policy that only gives you a fiscal benefit whenever you're changing your behavior, whenever you're actually investing, that's going to be a more effective form of investment. Okay, so just to kind of summarize some 3 lessons from policy research. Tax policies can influence some outcomes. So we've seen effects on investment, employment, sales. We haven't seen effects on productivity, at least in these examples. They're more effective if they're actually targeting active investment as opposed to rewarding everybody whether they invest or not. And then finally, tax rules may be more effective at stimulating investment than income tax rates. And we've showed this in the case of profit shifting and sales tax. Okay, thank you.
Well, it's nice to be back in person. I'm going to be talking primarily about the international tax environment and how it affects the corporate tax and what the future of the corporate tax is in that context. I like to start a discussion like this with, as Juan and Carlos says, we're better at analyzing history than we are at predicting the future. And this is a picture of the all-in headline corporate tax rates for the G7 countries going back to 1990. And it's pretty obvious from this that tax rates have been going down. We know that the US had a major reduction in its corporate tax rate 5 years ago, as we've already discussed. But the US is definitely not alone. Indeed, the US reduction in the corporate tax rate and the arguments for it were really driven by what had been happening around the world, where the US had gone from being sort of a low middle tax rate country at the beginning of this period to the highest before the Tax Cuts and Jobs Act. Not just for the G7, but for a much broader group of advanced countries. So the question is, what's going on? And to keep in mind that this has very little to do with the politics of individual countries. You can see, for example, reductions in the French corporate tax rate during the previous government, which was a socialist government. So you've had reductions in corporate tax rates across the G7 and more advanced economies when you have right-leaning governments, when you have left-leaning governments. And so it's clearly being driven by something much more fundamental than cyclical political changes. And here's a way of summarizing what's changed. Look at the top 5 by market capitalization. Look at the top 5 companies in the United States 50 years ago and today. And remember that when looking at this, that AT&T is not today's A&T, it's Ma Bell. It's the all-inclusive regulated monopoly that existed at the time. And some of you may remember some of these companies, like Eastman Kodak. Other companies still exist. But the key thing is that the companies in 1972, even though, as in the case of IBM, they may have relied a lot on technology, were companies that manufactured things. Even AT&T did. They manufactured your telephones back then. To the extent that they had international operations, a lot of the international operations involved exports. It's true that GM was making cars in other countries, But a lot of what IBM was doing may have been manufacturing business machines in the US and exporting them. So yes, some multinational activity, but a lot of international activity through exports rather than through actual supply chains located around the world. You move to 2022, and you have these companies, and except for there is some manufacturing. Clearly, Tesla manufactures cars, Apple manufactures phones, but there's a much higher dependence for all of these companies on intellectual property. That's one difference, and the other is that these are all multinational companies that have international supply chains and manufacture around the world. And what these two developments in changing in the corporate sector have done, that is the higher reliance on intellectual property and the greater amount of multinational activity, is they've made it much more difficult for individual countries to implement and enforce traditional corporate income taxes. Because these taxes depend a lot on identifying where profits are being earned. And when you're operating in one country and you're using physical plant and equipment to do so, it's pretty easy to say where your profits are being earned. When you're operating around the world, and an important part of your asset base is intellectual property, which you can see where a steel plant is. It's a little harder to figure out where a patent or the underlying intellectual property is because it's not really anywhere. And so it's made it much more difficult for countries to enforce tax systems. And that's really the primary driving force behind these reductions in corporate tax rates, as countries have engaged in heightened tax competition. So the question is, and the question that has occupied many people around the world in recent years, is what to do about it. And although much of the focus jumps immediately to potential solutions, I think it's important to keep in mind that there's two different paths that a country can go down. And one is a cooperative path where it tries to work with other countries in coming up with a solution, and the other is to go it alone. And we have examples of each of these approaches from recent policies enacted and policy discussions. To me, the best example of countries going it alone is the rise in what are called digital service taxes. So over the last decade or so, countries, especially in Europe, but not exclusively in Europe, have adopted taxes, and you might think of these as evidence of or characterized by reverse engineering. So a bunch of countries looked at large digital companies, and you can think companies like Google, for example, and they said, okay, these are big companies. They seem to be operating in our country. People are doing searches using Google, or they're on Facebook. They're in our country, but we're not collecting any taxes from them. So the reverse engineering aspect of it is they said, what change in our tax system, or what kind of tax would make it possible for us to collect taxes from them? And the answer that they came up with is digital service taxes. That is, instead of doing what we do traditionally, which is taxing companies based on where their profits seem to be earned in terms of their production, let's just see where their users are. Not really the purchasers of their services, because as, for example, in the case of Google or Facebook, these are not monetary transactions. But if you broaden the definition of consumer to be people who are somehow benefiting from the use of your product, then you can say, they're in our country, we're going to tax them. And so that's what digital service taxes amounted to. And here's a picture, and you'll see it's from the Tax Foundation, from earlier this year, of countries that had adopted digital taxes. And a key thing to note here is that, and these are countries at different stages of adoption of digital service taxes, and an important category here are the countries in green. And you'll see that the legend says, repeal contingent on Pillar 1 implementation. So these were a bunch of countries that had adopted, France was an early adopter, that had adopted digital service taxes, but it also agreed that, this is what I'm about to come to, if something else happened, then they would give up their digital service tax in place of something else. What is that something else? Well, that's the alternative path that a country could go down, which is cooperation. And this is what's already been referred to, the OECD's pillars 1 and 2, two different sets of provisions aimed at reforming taxes on a worldwide basis. That is not for individual countries, not just for the 40-some countries in the OECD, the more advanced countries in the world, but really for a much larger group of countries. It's just that the ideas and the drafts emanated from the OECD. So what are these? And you've already heard a little bit about it from Becky, but I'll go into a little bit more detail here. Pillar 1 is a tax only on very large companies. And it's a tax on the biggest digital companies based on income where their users, a certain share of their income based on where their users are. So it was very consciously designed as a way to substitute for the digital service taxes. And so it is this pillar that, if adopted widely by a group of countries, would serve as a substitute for digital service taxes, and that's really how it was helped motivate its formulation. Pillar 2 is a 15% minimum tax on profits, where each participating country would impose this tax not simply on the profits earned in its own jurisdiction, but on profits for companies operating in its own jurisdiction, to the extent that these companies weren't paying tax on profits in other countries, essentially non-participating countries. And I think Becky referred to the enforcement mechanisms built in. These provisions were put into the design of Pillar 2 as a way of getting countries to participate once other countries had agreed to do so. Because if you're sort of left out, then then other countries will tax the earnings that you are choosing not to tax. And the design of Pillar 2 had in mind arresting this race to the bottom, the reductions in corporate tax rates that I showed you in my first slide. Because the idea would be there'd be no place to go, if these were widely adopted, there'd be no place to go to have your income taxed at a rate below 15%. So there were, I think, 140 countries participating in this process, which was sort of dubbed the inclusive framework, because so many countries were involved. And in the fall of 2021, the number of countries, in part due to the successful arm twisting by Janet Yellen and others, and perhaps Kim at the US Treasury, was 136 of 140 countries. So pretty universal agreement by those countries to adopt. Now, I carefully note that I said agreement to adopt. The number of countries that have actually adopted it so far is 0. So you've noticed it hasn't happened in the US, but the US is not alone. So what are the reasons for that? Well, there are a bunch of issues. One is that fundamentally, you're talking about, obviously, if you're talking about 136 countries, you're talking about a heterogeneous group. And there are some countries in there, particularly countries that are less developed. Think of the Eastern European transition economies in particular, countries like Poland and Hungary, that like having low taxes in part because they don't have the same richness of capital as more established economies do. And so they like the idea of offering tax incentives to get people to invest there. And this was basically saying, sorry, we're ruling that out, at least to some extent. There are also the incentives to adopt depending on other countries adopting. I already referred to that in discussion of Pillar 2. So if you're the last country to adopt, you certainly want to adopt, but you don't necessarily want to be the first country to adopt, because if you are at the head of the pack and you look around and nobody's behind you, then there are disadvantages. Similar to some of the disadvantages that we introduced in 2017 in some of the provisions intended to protect our tax base, but provisions that only apply to American companies and not to companies that are operating based on residence in other countries. And then there are further complications having to do with simultaneous adoption. For example, questions about the extent to which these provisions are not consistent with existing tax treaties. And those treaties may have to be rewritten and renegotiated. And while a collective agreement to do so might work if all countries agree to such a new model treaty, it's hard to do on a one-off or piecemeal basis. So what's the outlook in the US given this current state of affairs internationally? Well, there hasn't been any serious consideration of Pillars 1 and 2. But instead we got the Inflation Reduction Act. As you heard, a 15% tax on the book income, the financial statement income that companies report, and a 1% tax on share repurchases. And the way I would characterize these provisions instead of Pillars 1 and 2, it's sometimes said that the perfect shouldn't be the enemy of the good as an argument for adopting good policy. I would say this is more a case of the fair shouldn't be the enemy of the poor. That is, the policies, the Pillars 1 and 2 are definitely not perfection. And the Inflation Reduction Act provisions really leave some people scratching their heads. The book minimum tax, for the reason you've already heard, that it potentially both may be avoided by companies by changing their financial statement income, and may also worsen the quality of information provided by financial statements by encouraging companies to distort what they report. It's also, in some sense, a solution in search of a question. The question, I suppose, is, the issue is, I suppose, these companies aren't paying enough tax, and we don't seem to be able to reform our tax system in a fundamental way, the way we'd like it. So let's just do this sort of ad hoc approach. Well, the problem with ad hoc approaches that don't really deal with the underlying problem is that they don't necessarily catch the companies you want to catch. There was a recent paper by accountants at UNC estimating from available public information who would be subject to this minimum tax. And a couple of the companies that would, according to these calculations, pay the highest minimum tax included companies we don't think of as those international footloose multinationals locating all their profits in tax havens and relying on intellectual property. AT&T, Ford Motor, those are not the companies that typically come up in these discussions, and it really sort of illustrates that when you come up with an ad hoc solution, you get sort of an ad hoc result. I won't say, given time, I won't say anything about the tax on share repurchases, but I will say that these were really solutions in search of questions. It wasn't clear what problem they were solving. So what do we do next? Well, that's the hardest and most important question. It seems pretty unlikely that we're going to get US adoption of Pillars 1 and 2 in the near future or ever in the United States. Perhaps if there were worldwide adoption, the US would be pressured into doing it because of the incentives to do so if other countries do. But I'm quite skeptical that this is going to happen. And where do I think we should go? We should or may go instead? I think we can learn something from the other path, that is the unilateral path. It's not an accident that countries sought in their interest to adopt digital service taxes. Aside from taxing companies that were from other countries, which obviously made it politically attractive, they have the important characteristic that they're based on taxes based on where consumers are. And when you're having trouble figuring out where production occurs, one thing that is easier to do is figure out where consumers are. It's a lesson that states have learned as they've modified their corporate taxes in the US, moving more and more in the direction of basing their taxes on the location of sales, which now is the dominant way we tax corporations at the state level, but it was not always the case. The acronym that you heard referred to in the earlier session, the destination-based cash flow tax, the key word there is destination. And it was a tax based on where consumers are located. And as in these other cases of taxing based on where consumers are located, I think it's a more viable approach in terms of countries protecting their own tax base. And unlike what we're trying to do now through the inclusive framework of Pillars 1 and 2, it's something that countries can do on their own and benefit from it without having to engage in a very difficult to achieve international agreement. Thanks.
Thank you. I'm going to actually pick right up where Alan left off, which is a deeper dive on Pillars 1 and 2. I won't go into too much detail here because an overview has already been provided. But what I'm going to focus on in particular is business perspectives around these two pillars and focusing on US-based multinationals in particular. One thing to understand, and this point has been made, is what we have these two pillars, 1 and 2, which, as explained, really have no connection to one another from a policy standpoint. The companies within scope are different. The way it would be implemented is very different. So why are they together in the first place? Well, we're looking at 140 countries that are negotiating a package. Some countries saw something in Pillar 1, particularly those concerned about the taxation of the digital economy. Other countries saw more in the global minimum tax in Pillar 2. And so in order to have a viable political package, these two different pillars needed to be kept together to facilitate that October of 2020 agreement to move forward with this program. One thing I want to note on Pillar 1 that hasn't already been mentioned is if you look at the scope, there's about 100 multinationals, only a very small number of companies that would be caught by this Pillar 1 proposal, at least initially. In the way that Alan described it, which is the way that this is often thought of, is Pillar 1 is a response to digital services taxes, which is very much the case. What's notable, though, is if you look at the companies that are paying digital services taxes and compare that to the 100 that would be within the scope of Pillar 1, what you'll find is nowhere even close to 100% overlap. So if you look at the U.S. Trade Representative report on the French DST, you'll see there was a number of companies identified, U.S. companies that were paying the French digital services tax. Only by my math, about 30% of those companies are covered by Amount A, Pillar 1. And the reason for that is Pillar 1 is only focused on companies that are very large and highly profitable. You have to have at least a 10% profit margin on a consolidated basis to be caught by Pillar 1. Many of the US companies that are paying DSTs are very low margin or actually more startup in nature. Think of ride-hailing companies or hotel booking reservation platforms. So that's one just notable policy call is the problem being DST, you have a universe of taxpayers, but the solution is covering something quite different, and that was just around the politics in order to achieve an agreement. The other thing I would note on Pillar 1, the very last row, the implementation vehicle. This is very important, particularly for the US business community, which is looking at these two pillars and asking themselves, is this actually going to happen? So US companies they have finite resources, have to pool people behind certain things that actually have a viable path to being implemented. And with Pillar 1, because it involves changes to tax treaties, so it's going beyond the arm's length principle, which is enshrined in tax treaties. It's going beyond the permanent establishment standard, which is also enshrined in tax treaties. In order to breathe life into Pillar 1, those treaties need to be amended. The vehicle for doing that is referred to as a multilateral instrument. It is the case now, and it has been the case for quite a while, that there's no obvious path for the United States to sign on to a multilateral instrument, given the procedure that in the bipartisan support that would require. So for US companies that are within the 100 and are subject to this, certainly they are focused on Pillar 1 and contributing to the design, but there's wide skepticism in the business community as to whether Pillar 1 can be implemented procedurally in the United States. On Pillar 2, as noted, this is a completely different regime. So this is a 15% country-by-country minimum tax. Look at the scope. 6,000 companies are impacted by this. So 100 for Pillar 1, 6,000 for Pillar 2, totally different scope of application. Also look at the revenue score. Pillar 2 raises, at least it's estimated to raise by the OECD, about $150 billion US per year on a global basis. So quite a pretty significant revenue score there. The implementation vehicle, and again, this is thinking about this from the business perspective, there's a path for Pillar 2 to be implemented. It doesn't require, at least as it's been thought about by countries participating in this, is the primary rules that would give rise to Pillar 1 does not require those very challenging treaty changes. Most of this can be implemented through domestic legislation. So what that means for companies is there's a real path for this to be implemented. Jurisdictions around the world can take the OECD rules and actually implement it into law. And for that reason, there's a much bigger focus in the business community on Pillar 2, the minimum tax. That's both because it applies to more companies, also because the impact is bigger in terms of, if you think about effective tax rate, cash tax, it's a bigger impact, but it also is just much more viable. It has a clearer path to actually being implemented. When I think about business perspectives on Pillar 2, so that focusing on this global minimum tax, I think there's broadly 3 different ways I would categorize what the U.S. business community is focused on the Pillar 2 side of things. The first is there's so much uncertainty as to the course and speed of implementation that it's making it difficult to make decisions and plan. The second is there's concern that the way that Pillar 2 was put together was agreed by 140 countries on a rapid timeline, didn't allow for enough debate on the calls that were implicitly being made. In particular, there's concern that certain incentives that have broad support, including in the United States, would be undermined by this global minimum tax. And then the third perspective is very, very significant increase in compliance and reporting obligations, often for companies that go through all the math and find that they owe no tax. So there's quite a bit of concern for the 6,000 companies that are in scope. If you're not operating in low tax jurisdictions, you're wondering why you have to go through and do all of this math just to prove out. So unpacking those a little bit, so this has been described already. So the uncertainty on just the course of implementation. Alan mentioned 140 countries in October of last year agreed the outline, but no one has yet implemented. I think the weight of opinion in the business community is while there's uncertainty, the expectation is some major economies, some G7 economies, will have implemented these rules by the end of next year. France and Germany in particular have made very clear, they've made public statements within the last 6 weeks that they have every intention of implementing Pillar 2. So I think the business community's baseline expectation is there will be Pillar 2 rules implemented around the world, and France and Germany seem poised to do that as soon as next year. But that's far from a certainty. But knowing who is going to implement, when they're going to implement, through what legal mechanism, makes it very difficult for businesses to plan, both from a resource standpoint, but also in terms of investment decisions. If your current operating model is set up under an old baseline, Pillar 2 brings an entirely new baseline. A 15% minimum tax in every country is quite different than today. And so it makes it difficult to know, do I change my operating model? Do I keep it the same until there's more clarity? And so that is making it difficult for businesses to both plan but also think through investment decisions. In terms of the tax incentives, this has received quite a bit of attention, but the main point here is that establishing a 15% minimum rate in every jurisdiction, that's commonly perceived as, well, this is going after Switzerland and Ireland and Singapore and Hong Kong. What the U.S. business community has found, and myself in particular, having helped about 100 companies do the modeling, is I have found oftentimes about 1 in 5 to 1 in 6 U.S. companies has a U.S. effective tax rate less than 15%. So Pillar 2 will undermine U.S. tax incentives. And I'm not sure that was fully appreciated at the time that this deal was put together. So why would that be the case? We have a 21% federal rate. State taxes are included. Well, we also have a lot of incentives. We have general business credits for things like research and development. We have certain incentives for foreign exports called FDII. We also have incentives to allow amortization of goodwill in the case of acquisitions. All of those things are drags on the ETR. And if they're big enough, they can take you below 15%. If that is in fact the case, and by my rough estimation, that's about 1 in 5 and 1 in 6 US companies, that's going to trigger those companies to pay more tax in places like Canada and France. And that has received quite a bit of attention in the United States. Other types of incentives that have been very much in focus recently is how would this regime respond to things like low-income housing credits? How would it respond to energy credits? There's been a lot of letters written in concern about this, and I think Treasury has worked very hard with the OECD to try to protect those, but we're waiting for final guidance to confirm that result. One thing that is also important, if you sort of look down at the solutions, technical clarifications are able to, I think, protect some U.S. incentives. That's very much the low-income housing and energy credits potentially. Other solutions that I think you could see countries look at, not just the United States, but much more broadly, is redesigning their tax systems. In particular, Pillar 2 is more friendly for credits that are structured as refundable credits. Essentially, under Pillar 2, if the credit is refundable, it's treated like a government grant, which for accountants means it goes above the line. So it's treated as increase to income rather than reduction to tax, which is a bit technical, but what that means is you have a slightly higher effective tax rate under that mechanism than if you just leave it as a regular credit. So my expectation is if this regime is in fact implemented, I think you can expect virtually every low and mid tax jurisdiction to immediately adjust their tax system to make all their credits refundable. Many of them have already indicated that. And then finally, in terms of the compliance, just briefly, this is, if you think of a US-based company that operates in 100 jurisdictions, which is not uncommon, that's actually quite common. What Pillar 2 is focused on is, are you paying a 15% rate of tax in all 100 jurisdictions? Well, in order to establish that, you have to compute an effective tax rate in 100 jurisdictions. Importantly, Pillar 2, the way it measures income and the way it measures tax is novel. It's different than any existing system. It combines financial accounting concepts with tax accounting concepts. And so companies are having to retool their systems just to produce the information that this regime requires. US-based companies are particularly exposed to the compliance side of this because we already have in addition to Pillar 2 potentially being implemented, we already have 2 other minimum taxes, and these have been referenced. So in 2017, there was the enactment of the GILTI regime, which is a minimum tax that operates slightly differently but requires a series of calculations in its own right. And then now, most recently, we have the enactment of the corporate alternative minimum tax, which again is another form of minimum tax with just different definitions. And so for US companies that are within the scope of all 3 of these regimes, you're subject to 3 minimum taxes using 3 different definitions of income and tax, and the compliance and the complexity around sorting out how do all these various things stack on top of each other is something that has been keeping me busy. In terms of solutions, the OECD is obviously alive to the compliance. And has been working hard on simplification measures and safe harbors to try to streamline the compliance. I think we'll get a report from the OECD in terms of where that stands as soon as the end of this year. So I think with that, in closing, while no jurisdiction has yet implemented, the expectation of myself and I think the broader business community is we will start seeing some jurisdictions implement. Probably Germany and France seem poised to do it, but we will find out at next year's conference if that's actually the case.
Fantastic. So thank you very much to the panelists for a very wide-ranging and excellent set of comments. I very much appreciate it. So, I guess before I have a couple of questions here. Before that, do any of you want to respond to anything from the other? Launch into some questions here. Okay, so the first couple of questions I have are related to these international tax provisions and directed at both Alan and Marcus. So, Alan, you had this question, do we cooperate or do we kind of go it alone? And there was this decision, at least by the OECD, to try to get to some type of cooperation and hopefully, stop this race to the bottom or stop income shifting incentives, et cetera. But then if countries can do things like engage in refundable credits, or if we think about a state and local setting where they can give one-off, sales or property tax abatements, even if all of this gets implemented, would we just be back in the same place where effectively countries are still competing for companies and revenue? They just do it through different mechanisms.
Well, I think, I think Marcus made an interesting point because he said in some sense we're imposing taxes on companies we may not want to impose taxes on because of the provisions that we want to give incentives for. And on the other hand, companies will have opportunities through refundable credits, through government grants, through other taxes. I mean, there's nothing that keeps a country from reducing its payroll taxes for corporations to lower the overall tax burden of their operations, because only the corporate income tax is covered by this. I think there are many problems. I mean, to me, the basic problem is there's two basic problems here. One is you're trying to use a single instrument applied to a very heterogeneous group of countries to accomplish a particular objective, and I think that is hard in itself. I think the other thing is that adhering to the model where you somehow know that you think you should be taxing profits based on where corporations do their production, I think is become an outmoded approach, and we're still trying to preserve that approach through putting various bells and whistles onto a very increasingly unwieldy approach to taxation. So I think I don't want to predict or disagree with Marcus about whether countries will adopt or won't, but I think we're going to be, a few years from now, I'm pretty confident we're still going to be searching for a different solution.
So Marcus, following up on that, you spent time at the OECD, now you're talking with clients a bit. So there was a choice for Pillar 2 to be this global minimum tax. Were there other types of policy mechanisms that were considered or debated, or can you comment a little bit on the convergence to this as the approach, potentially, to try and mitigate this type of income shifting or race to the bottom in activity that the countries and companies engage in?
Yeah, I think of the 140 jurisdictions within the inclusive framework, Pillar 2 was responding to two related but slightly different things. The first group of countries thought the first BEPS project, which established some new requirements to limit profit shifting, country by country reporting, some new substance requirements, strengthening the transfer pricing rules. But the view was it didn't go far enough. We're still seeing some evidence of profit shifting. And this group of countries was looking for Pillar 2 to essentially patch holes that were left open from the first OECD BEPS project of 2015. The other camp, and I think the US and most other large developed G7 countries were in this second group, it was more about tax competition in establishing a floor under tax competition in particular. And one interesting thing about the OECD is that sort of divergence of view is never really resolved. Rules are just written, and countries try to reflect their policy priority in the design, and whatever comes out in the end is what comes out in the end. So, in a sense, was there other things considered? It was always envisioned as a global minimum tax. Probably the biggest policy call was, how are we measuring that? Is it a global aggregated calculation? Right. That's how our current GILTI operates. Or is it country by country? If you're in the tax competition camp, country by country is a pretty obvious. You can't stop tax competition if you're allowing Japanese taxes to blend Cayman taxes or lack thereof. So I think that was probably the biggest policy call that was made, which I think took us more in the direction of the tax competition camp, was to do it on a jurisdiction by jurisdiction basis.
So one of the things I'm taking out of the several different comments here is the importance of the base on which the tax is assessed and how that's calculated. And I suppose, if nothing else, there will be a healthy market for accountants going forward, because there's all of these different bases that have been proposed. I don't know if that's a fair way to sum up some of the comments that you had earlier in the type of work that you're doing with the companies today.
Yeah, I mean, these are quite technical things, but I mean the base is different. I had mentioned there's these various regimes, global minimum tax regimes out there. We have GILTI, which was enacted in 2017. That's very much a U.S. tax accounting notion of income. We then have CAMPT, the new corporate alternative minimum tax that the Inflation Reduction Act brought. That's financial accounting income, but not quite. It makes adjustments for things like accelerated depreciation. And then we have things like Pillar 2, which are financial accounting, but make different adjustments. In the case of Pillar 2, they thought permanent benefits related to stock-based compensation is fine, whereas the corporate alternative minimum tax, stock-based compensation is actually the primary thing that regime is responding to. So you have sort of a schizophrenic approach to defining income with no clear reason why.
I want to switch gears a little bit and go back to the domestic side of it, and a question for Juan Carlos. So the 2017 Tax Cuts and Jobs Act was a huge piece of legislation affecting both the U.S. corporate rate and then also the international provisions. Thinking about the U.S. corporate rate change and the other changes, for example, increased expensing, those types of things, what do we know in the academic research right now about the effects of that? What do we not know, and what are the open questions that we wait research and evidence on?
I think it's a great question. I think this is one of those things where, I've looked at a lot of papers. People are trying hard to answer this question, but at the end of the day, if you turn over the 8-ball, it says "ask again later." I think there's not great consensus right now. Partly because of all the things that have been going on. We had a trade war at the same time. Then we had COVID. So I think the jury's still out for now. In terms of, I think on the domestic side, I'm very interested in thinking about the domestic impacts of international tax provisions. I think even when you think about the OECD Pillar 1, Pillar 2, for U.S. companies, it's really going to depend on how they interact with existing rules like GILTI. I think we don't really quite know how much companies are paying in terms of GILTI taxes. I think they're actually the tax receipts are coming at higher than they were scored, I believe. And so there's a potential that's going to have more of an impact domestically than we anticipated.
I'm going to add on an additional question here, because you talked about income shifting and profit shifting and some of the work that you've done. And so a lot of the international changes in the U.S. plan, as well as these other changes, are intended to try to mitigate the income shifting that U.S. multinationals and other multinationals engage in. How do we think about what companies may or may not do, given all of these different changes that we've talked about today? So the Tax Cuts Act, TCJA, and then these different Pillar 1, Pillar 2. Really Pillar 2 here.
Yeah, I think in response to TCJA, I've seen research showing that companies are repatriating some of the intellectual property. And I think if they're already doing that, then maybe the impacts of the Pillar 1, Pillar 2 might be smaller if they're already responding to this. So I think it's going to be really tricky to try to separate all those things that are responding at the same time.
Great. So Alan, at the end of I'll ask one more question, then we can open it up here. So Alan, at the end of your talk, you kind of ended it by saying what's next if Pillar 1 and Pillar 2 are not implemented. The head of the OECD's tax initiative, so Pascal Saint-Amans, is set to retire next Monday, Halloween. I don't know why he picked that date, but he's set to retire then. The U.S. is obviously facing a pretty vigorous midterm election process that could affect who's in D.C. and the tax positions of legislatures. How do each of you think about, kind of the road ahead? Recognizing that as researchers, we often looked back instead of forward. But how do we think about these different changes and the likelihood, again, going forward that there might be some activity, whether on the domestic side or on the international side for future, to address some of these domestic and international tax issues? Marcus, I'll start with you. You're closest to.
Well, Pillar 1, Pillar 2, I think of them, at least myself, very differently. I think Pillar 1 is, it has that challenge on the implementation side that will make it difficult for it procedurally to come into force. But it's important to recognize if that is the outcome, if it fails, there's going to be a further proliferation of digital services taxes and bring us right back to where we started. So in the short term, Pillar 1 doesn't have an obvious path forward, but the problems that underlie it are not going anywhere. And so I think in even the medium term, you could see some concept, maybe it's not called Pillar 1, but there needs to be some solution to that underlying problem. And then on Pillar 2, in the United States, of course, it's very difficult to predict, but I also don't think there's a short-term path for the U.S. to implement Pillar 2, which in a U.S. sense means amending our existing rules to at least not be obviously misaligned with Pillar 2. But outside of the United States, I do expect, as I said, I do expect at least some major economies will proceed with the implementation of Pillar 2, if nothing else, to finance the spending in Europe on energy, on COVID aid, and a number of other government interventions that have resulted in gaps that need to be filled. So I do expect Pillar 2 to move ahead in the short term, but outside the United States.
Do you think that with France and Germany adopting, they'll be able to strong-arm other countries in Europe as well, or will they really be going it alone for a bit of time?
Well, if France and Germany is able to go it alone, the mechanism of Pillar 2 is arm twisting in its own right? So it's more a question of, can France and Germany procedurally implement within the confines of EU rules? Because generally tax in the EU requires unanimity. Hungary is preventing that from happening. And so Germany and France have all the enthusiasm in the world to implement. It's just a question of how do they do it outside of a directive. But I do think they'll find a way. And if they do, then I think that'll be a domino.
Well.
I think we can all agree that nothing's going to happen in the U.S. in the next couple of years. I still think that I think that one thing we haven't talked about is Marcus suggested that Pillar 2 is something that's envisioned as being adopted by individual countries. I think there's some controversy over whether that is possible, or whether that also would involve violations of tax treaties, in particular with respect to taxing the so-called undertaxed income in other countries that aren't participating. There are special problems in the EU for the reasons you mentioned, but even for other countries. And so I'm not convinced that there's a smooth path for individual countries that are enthusiastic about adopting Pillar 2 for them to do so without facing some sort of international legal challenges. I still think that unilateral action is going to be a fallback position. And whether it's through digital service taxes, which will certainly exist if Pillar 2 isn't adopted, because these countries already have adopted digital service taxes. I think we may see other countries adopting them, or searching for alternative approaches to taxing based on destination that is something that is much more feasible for countries to do unilaterally without worrying about it harming their international competitive position.
Great.
I have two predictions about the future.
Okay, with the magic 8 ball.
Yeah. The first is that economic policy research into tax, corporate tax, international tax, is going to have higher value in the future.
That's good for the researchers in the room.
Exactly, this is great.
Yes.
And the second is accountants are going to be fully employed.
Right? If we can, With that, let me open it up for some questions here. I'll start here and then over here. So, great.
Yeah, the tax table, yeah.
Yeah.
Well, one of the other things that the OECD never squared was their own economic research and their desire for a global minimum tax. OECD found a number of years ago that corporate tax is the most harmful tax for economic growth. And yet now they want a global minimum tax. One of the things we haven't talked about is the economic impact of having a global minimum tax. And when the OECD did their impact assessment, they didn't find much of a large economic impact. And that struck me as kind of funny. I wonder if you could talk about that. Beyond just the complexity issue, how much will this add friction to FDI, cross-border capital flows, et cetera, and what broader impact might that have?
I'll say something about that. I think, sometimes we just, one of the things we do in research is say like, okay, well, there's a change in one location and then the activity moved. And we could say, well, there's an effect in activity. Sometimes it's harder to know whether that change in activity was because there was a distortion or because there was something that was like an incentive. So it's, just because things move location doesn't mean that it's good or bad, right? And so I think if you step back and look at the global landscape now and think like, okay, are companies operating in the places where they should be operating, or are, for instance, the operations in the US larger than would be desired from a global perspective because a lot of the foreign profits of US multinationals are not taxed abroad, right? And so if you want to think, okay, well, maybe right now activity in the US is too big relative to activity in Europe because US multinationals are benefiting from regimes that don't tax their foreign earnings. That's a possibility. And so I think one of the nice aspects that I like about a global minimum tax is that it could remove some of these distortions and it would actually reallocate activity to places where it's more productive. I think that's the upshot of it. But of course, you have to take a stand on whether or not losing jobs here or getting jobs there is going to be good or bad.
So I have a question for Marcus, even though, Alan, I really want to hear about the 1% tax on dividend buyback, so I'm going to catch you during the reception happy hour. But Marcus, one of the things that this seems obviously about, is a search for revenue. You have a lot of countries who have a lot of expenses and expenditures for a welfare state that they can't afford, and they're trying to find ways to raise revenue. I don't think Pillar 1 is going anywhere either. I think Alan's right on that for now. If it really does impact roughly 100 large companies, maybe you're trying to target 30 or 40, would it be wiser, smarter, and more efficient to use transfer pricing and APA agreements and have the IRS sit down with the most affected countries and those companies and come to an advanced pricing agreement that you could settle for 5 to 10 years, so there'd be certainty about the revenues being paid up front?
Well, yeah.
Can you take a minute and just for everyone describe what an APA
Yeah.
is at a high
There's
level?
a few different.
At a very high level, very high level.
Yeah. Well, maybe just Pillar 1 is, it doesn't really raise revenue, right? It's more of a reallocation, reshuffling. It's you're paying tax, income that's in Ireland maybe should be in France under this mechanism, and so it does raise some revenue because you're tending to allocate revenue to developed economies that have a lot of customers tend to be high tax, and so there tends to be an extra incremental tax burden on that. But the tax dollars aggregated, on a global basis for Pillar 1 are a pinprick. Now, it could be a significant impact for any individual country, but in the aggregate, it's more of a reshuffle. So Pillar 1 isn't really about necessarily raising revenue. In terms of whether there's alternative mechanisms to try to deal with it, I mean, ultimately, it's Pillar 1 is responding to, I think, largely a political concern in some countries, particularly in Europe, that large digital business models are not, the existing rules don't respond to them. And there needs to be changes to make sure that these digital business models are being taxed. So I don't know, the solution would need to be very targeted at something related to the digital economy in order to satisfy the concerns that are giving rise to Pillar 1, or at least the biggest digital companies would need to be caught up in it. I don't know that APAs, which are essentially governments agreeing on intercompany pricing, maybe that could help, but I'm not sure if it's proximate enough to the digital economy problem to necessarily be a solution. But it's an interesting, I think the OECD has taken ideas at this point, so.
Given transfer pricing was this small when I was doing it 20 years ago, and now it's this small
Yeah.
when you're doing it today, that could be a avenue to consider.
Yeah.
I'm so honored to be sitting at the tax table. I can't even tell you. Well, I'm sorry, but the main thing I got from the last 90 minutes is that Pillar 1 and Pillar 2 might be DOA. So to ask a maybe bigger question, maybe more optimistic question, to go back to Scott Hodges' framework from the last session, if you could, wave a wand, or if you were king of the world, is there a single tax policy change that you think really could raise economic growth globally? And if so, what would it be?
I'm going to crib from Kim and just say that I think we need a carbon tax. I think that's, and just to go beyond growth, I think,
We can't go beyond growth.
well-being is not just economic growth, and I think it's important to realize.
Yeah, I'll sign on to a carbon tax, and since that doesn't count against my choice, I still like the DBCFT. It was the destination-based cash flow tax. It was rushed out in 2016 as a proposal, and it's one of those rare cases of it happening too quickly rather than too slowly. I think the ground hadn't been laid for it in terms of its people's general understanding of it, and I think as time goes by, I think that'll be less of a problem, and I think it still is a solution to a problem that we're struggling very hard and failing to address.
So I'm slightly more optimistic on Pillar 2 than DOA. But, understood, I'm in the minority perhaps. But I would agree with one of the prior panelists of expanding immediate expensing.
So I'm not a panelist, but I'm going to take the moderator rights here. And actually, something that is not necessarily a change, but I'm really interested to see what happens with it is the country-by-country reporting. So this was an earlier initiative as part of the OECD's efforts to really try to minimize this income shifting and base erosion and profit shifting efforts that companies go through. So one of them was to impose country-by-country reporting. So as an accountant, I think about reporting issues. That's really forcing companies to think and have to report to their tax authorities and exchange that information currently right now among tax authorities. So there's some nascent research that's starting to understand, is that actually changing how companies think about these issues, knowing that they have to report it? So not a change, but something I'm interested in. We have one more question here at this table.
Yeah, by the way, I'll add my vote for a carbon tax. But on this Pillar 2, it sounded like the compliance costs were pretty substantial. And the question, for 6,000 firms, if I understood that right, has anybody actually figured out how those compliance costs aggregate and whether they are a serious concern for this policy?
There hasn't been any formal study undertaken by the OECD to quantify that, partially because there's still ongoing work on simplification measures and safe harbors to try to reduce the compliance. But at least in my experience, having now been working with companies, most are having gone through and done some of the calculations and picking one or two jurisdictions as a sort of pilot. They're putting in say 2 to 5 additional FTEs into budgets in order to just deal with Pillar 2. Many of them require substantial upgrades to their accounting reporting systems to produce the information. So my sense is it is a very material cost, but I don't think there's been any formal study done yet on what that aggregates to.
Country by country also added to their cost as well. So you're piling on top of what's already there. Mm-hmm. And they already had to add FTEs
Yes.
in order to do CBD.
Yes. Great. With that, talking about accountants and compliance cost, I just leave that behind. I just want to thank this outstanding group of panelists for your thoughts and your comments today and for the questions. Really appreciate the engagement in the session. Thanks, Mark.